So the paper is about capital regulation, and I will present a model which is designed, in fact, to assess more broadly macroprudential policies. So in that context, macroprudential policies are policies which try to isolate the real sector from financial shocks, so systemic risk, or to answer the question raised by Martin yesterday, is something where disorders in the financial sector may impact materially the real economy, and that's what you want to prevent with macroprudential policies. So you have different set of tools. Some of them are structural, so you can raise the requirements for whole institutions, so that's the scope of capital regulation. And the innovation in macroprudential policies that you can also try to change those requirements over time and depending on the state of the economy. The paper I'm going to present is very much related to other papers that were presented over the past 2 days, in particular those of Tobias Adrian, Anil Kashyap, and Frédéric Malherbe. So you will see some connections. So there is a long list of co-authors, so it's quite unusual, so I'll explain why, but these are mostly central bankers. So Catarina Mandicino is from Banco do Portugal, Stéphane Moyen from the Bundesbank, Alexis Dervis from the Czech National Bank, Kalin Nikolov and Livio Straka from the ECB, Javier Suarez from SEMFI, and Alexandros Vardoulakis is a former Banque de France and now works at the Federal Reserve Board. But I'll explain why we have this team later on. Yesterday we talked about the progresses made in the modeling of financial instability, and that was during the roundtable, and the conclusion was a bit mitigated. So I'll try to start the presentation by showing you that there have been indeed some progresses. So I don't know whether you remember these figures. They are taken from 2 papers that were published by the BIS. And this is the outcome of research that was carried out on behalf of the Basel Committee in 2010. And the idea was to try to assess the impact of Basel III. And this is the outcome of this research, where you have the net effect, so the benefits here, these are net benefits of regulation, depending on the level of capital requirements. And you sort of find that there is a level around 14–15%. So this is Basel II definition, where you sort of have the maximum net benefits. Now, in order to produce these figures, there were more than 40 economists, which were split in 2 groups. One group was looking in the long-term impact, so basically they were computing the benefits of the regulation, while the other group was looking at the cost, the transition cost to implement this new regulation. As far as the benefits are concerned, in fact, the approach was really not satisfactory, in the sense that it was not really relying on models, but people were trying to assess the extent to which 1 point of capital, of a regulatory capital, was the impact of 1 point of regulatory capital on the probability of default. So, and then the team also looked at different banking crisis episodes to compute the cost. And then when you have the probability and the cost, you have the expected benefits of increasing capital requirements. And the other part use a set of models. But at that time, so it was in 2010, there were basically no macroeconomic models in which you have a financial sector. So most of these of the models that were used in mostly central banks and international institutions were real models. And so no financial intermediaries, and therefore no capital and no liquidity. So to produce the figures, people used a wide range of econometric models, more than 80 models, and then the result here is the median of the responses provided by these models. So 4 years later, so over the past 2 years, there have been a lot of research carried out in the context of developing a macroeconomic model, mostly our DSG model, in which you have a proper financial sector and capital playing a role, and eventually liquidity. And this is the outcome of some of the papers. So you already seen the paper by Adrian. Today I'm going to present this paper. So what you can see here is that there is a hump-shaped response of the economy to the increase of capital requirements. So these are steady state impacts. So there is a hump shape, so there is broadly this idea that there is an optimal level of capital requirements. So at some point you have the maximum of the benefits, and then if you go further, you start impacting on the economy. The second common characteristic of this model is that there is some form of asymmetry, which is that when capital requirements are low, there might be actually no benefits or even costs, and when you increase them only slightly, then you have a massive improvement. And then at some point you may have cost, or it is more or less pronounced depending on the framework. So the idea is that it's better to increase capital requirements and to avoid areas where capital requirements are too low. And then eventually on the other part, it depends on the model. So with this kind of framework, you have the impression that, well, in fact, having high capital requirement is not necessarily costly. You have a loss, but you are still in the area where the outcome is positive. In this kind of setup, well, at some point it's really costly. And what I'm going to present is the outcome of this research and how we get to that. So so as you have seen, so there were many people involved in the project. So this is a collective effort that was carried out in the context of a network, MARS, so which stands for a Macroprudential Research Network. So I think the main outcome of this research network were presented by Philippe Hartmann at the last conference or seminar series. So, and in this context, I propose to develop a model in which we can assess the impact of macroeconomic regulation, and where we try to factor in the main feature of financial instability. So the aim is really to have something which is a tool that can provide information and which can also support the decision by policymakers to implement macroprudential policy. So today I will present only the theoretical part, but the intention now is to develop the model to introduce more quantitative features. So the main novelty of this model is to integrate default in the model. So in this setup, we have 3 layers of default. Banks can default, entrepreneur can default, household can default. And they will default depending both on idiosyncratic or macroeconomic shock. So this is also a departure from the classical financial accelerator literature, in which there is the possibility of default, but the contract you have, you can write a state contingent contract which isolate the possibility of default from aggregate shock. So in this setup, we cancel this possibility, so therefore contracts are incomplete, But then aggregate shock can have an impact on the default of macroeconomic agent. And here, when there are significant shocks, so be they idiosyncratic or aggregate, so they can generate default, and default will impact on the other sectors. So you have like a contagion mechanism, which is due to the possibility of default. So in the paper, we focus on capital requirements, but by capital requirements we have standard capital requirements, but we can play also with risk weight. So as was argued yesterday in the paper by Schalling and Kant. So you can play with risk weight, and you can also introduce a counter-cyclical buffer. And so we work also on extensions to add other macroprudential tools. So there are four main mechanisms at play in this setup. So the first, I already talked about it, is that external finance in this framework is subject to default risk. So you can have default in the three sectors who are the borrowers. And the fact is that the default are costly, so they generate date weight losses. So in our setup, we have also costly state verification, so like in the paper by Malherbe. And therefore, these are costly default. So the fact that there are date weight losses due to default has the following consequence. As it is costly for the society but also for the lenders, when default the default probability increase, then lenders restrict credit, the provision of credit, and so you can have in this situation underinvestment or a provision of credit which is too low with respect to what you would have otherwise. The second feature or friction in the model is that we have deposit insurance. So all the deposits are fully insured by the deposit insurance agency, and we have also limited liability. And this gives rise to an externality by which banks will take on risk. And the existence of this deposit insurance in the form of an implicit subsidy allows the bank to provide credit at a lower cost, and therefore in this setup you might have excess credit and therefore excess investment with respect to a situation in which you don't have this externality. The third feature is that we introduce a funding cost channel, which is due to the fact that despite there is this deposit insurance, depositors may face transaction costs to recover their loans, so it may take time, so therefore they bear this cost. And they charge a premium to the bank, which depend on the perceived risk of bank failure. Now the characteristic of this premium is that due to the opacity of the banking sector, the households are unable to monitor their banks, and therefore the premium depend on average default of the banking sector and not the bank to which you provide deposits. So here again, this has a negative externality, as risky banks will not pay a premium which is related to their own risk of default, but to the average of risk of default. And therefore, this provides them with an incentive to take on more risk, and therefore to provide more credit or in excess, and eventually inefficient credit vis-à-vis some firms which are not necessarily viable. And therefore you have also here in this situation excess credit. So if you take into account these three first channel or mechanism, you have either excess credit or excess investment, or not enough credit or underinvestment, and so the extent to which one effects dominate the other is unclear. So you need to carry out a proper analysis in order to get which effect dominates. And then we have a bank capital channel. So in our setup, banks are constrained by capital requirements. And capital requirements in our economy are only provided by a specific category of agents, which we call bankers, who accumulate wealth and then provide this wealth in the form of return earnings to the next generation of bankers. So that is the process of accumulation of bank capital. So it's inside equity in this setup. Therefore, when you raise capital requirements, and capital is really costly because it is scarce in the economy, you have an impact on the funding cost, and therefore you can have this negative impact on the production and investment and consumption. And here, what we have also is that aggregate shock can impact or destroy bankers' net worth, and therefore they cause also amplification and propagation in this setup. So here we are agnostic about the relative importance of each mechanism, and as I said, we can have both over and under investment in equilibrium. So the current model is calibrated on the euro area data, so it's just as an illustration. But obviously, it is also a limit to what we are doing, since we are not really relying on a proper quantitative analysis. So that's the model structure. So in our setup, we place banks at the center stage. So we have two kinds of financial intermediaries. There is a set of banks which are specialized in mortgage lending, and the other one, the other set, which is specialized in corporate lending. So mortgage banks provide loans to a part of the housing sector. So we have heterogeneous households. Some of them are net savers, the others are net borrowers. And in order to finance their housing purchases, they need to borrow from banks. And we have a corporate sector. The corporate sector consists of entrepreneurs who are the only agent able to manage capital. The capital, they rent it to the production sector. So production sector consists of two sectors, in fact, the housing production sector and the consumption goods sector. And these guys borrow in order to buy capital to a capital producing sector, and then they rent this capital to the production sector. So banks play a central role because they are the only source of funding in this economy, so you don't have alternative markets. So this is rather a representation of what we have in continental Europe rather than in the States, for instance. So the funding of these banks comes from two forms. The first is deposits. So there is a competitive market for deposits, and deposits are provided by rich or savers. And then they can also raise equity, and equity is provided by bankers. So and then I'm going to explain the content of the model. So first we have households. So as I said, there are two categories of households. The first set of households are borrowing households. So they need to borrow to buy their houses, but they will default when the value of their house is less than their debt payment obligation. They can borrow against, so the value of their house also serves as a collateral to borrowing. And then we have patient or saving households who supply credit to the banks, and these guys basically own the firms in the economy. So all the dividends are provided to these guys, and both entrepreneurs and bankers also provide dividends to this sector. Then we have entrepreneurs. So entrepreneurs are modeled as two period overlapping generation. And their net worth is transmitted through bequests to their heirs, so to the next generation of entrepreneurs. And so they provide inside equity to firms to maintain their capital stock, and here again they will default when the value of their capital stock or the return of their capital stock is less than their loan repayments. So, as I will explain, in those two sectors you have limited liability. So in the household sector it takes the form of risk sharing among families, and here it's limited liability, so you can default and then restart your business the next day. Bankers are modeled in a similar fashion, so there are also two period overlapping generation, and they transmit their network through bequests. So this is like return earnings, and this generates bank capital. And the banks can default when the net worth or the value of the portfolio is less than the deposit repayments. Banks have two characteristics. They enjoy deposit insurance, and therefore there is an implicit subsidy which allows them to provide credit at a lower cost. But at the same time, they are subject to regulatory capital requirements. And then we have a production sector. So here they are quite standard, so they do not face any financial friction. So the first is the consumption goods sector. So here it's pretty standard, so it's a competitive sector made of firms, and these firms combine capital, which is rented from entrepreneur, and labor supply, which is supplied by which is supplied by household. And then we have a capital good and housing good production sector. So these are two different sectors, also which are competitive sectors. And here the characteristic is that they face investment adjustment costs. Regarding macroprudential tools and welfare analysis, so as macroprudential tools in this setup, we have capital requirements. So capital requirements are used to protect banks from default, but also limit the implicit subsidy and therefore risky behavior by banks. On top of that, we can introduce counter-cyclical capital buffers, so which you may vary depending on the state of the economy, and you can also implement macroprudential policy by tightening some risk weight. So here we have two sectors. So you can allocate capital either to the household sector or to the corporate sector, and therefore you can play with the risk weight on corporate loans or housing loans. Welfare criterion. So in the context of macroprudential policy, there is a huge debate about the nature of this policy, as it is not neutral towards agents. So you have different categories of agents, but the fact is that macroprudential policy has a quasi-fiscal nature. So you generate transfers from categories of agents, in particular from borrowers to lenders and vice versa. So the question is, how do you compute welfare? So in our setup, we just focus on households. So the reason is that bankers and entrepreneurs also provide dividends, so or their consumptions to the housing sector. So we just look at welfare by looking or focusing on households. That's it. Okay. So what are the main results? So we have three main results in this paper. So the first is that in the steady states, we find that there are large gains from rising capital requirements when bank risk of failure is significant. But at some point, once banks are kind of protected from the risk of default, raising further capital requirements, bear some cost, and eventually can trigger credit restriction and eventually credit crunch if capital is scarce in this economy. So when we look at the dynamic, we shock the models, but we look also at a specific shock, which is what we call a bank risk shock. That is when the uncertainty about the soundness of the financial sector increases. And what we find is that there is more amplification or more traction or more action when bank risk is large or when banks are poorly capitalized, and the response is more muted when capital requirements are high. So there is here an amplification channel which is related to bank risk. And then regarding countercyclical adjustment, we also find that playing with capital add-ons in a countercyclical manner might have an impact, but only when you have already high capital requirements. When you release capital requirements in a situation where banks are poorly capitalized, on the contrary, you will not improve the financial sector, but you will increase bank default and therefore go into the wrong direction. So you will here provide more amplification and more recession. So here are some caveats. This is only a rough parametrization of the model. We use standard resolution methods, that is linear methods. There is no real transition analysis, and in the setup, bankers recover their wealth quickly. So related literature, so I will not insist too much on that. So there have been a lot of papers focusing on either introducing a bank default or bank capital channel in the setup. So the difference with this first strand of the literature is that in these papers, usually bank financing constraints on banks come from the fact that the bankers can shield a part of the outcome, whereas here the constraint come on capital requirements. I think here it's a different setup, but I do not insist as there will be a presentation just after me. So there is also a strand of the literature which focuses on fire sales and investment externalities, in particular Corinek and Jan, where you have pecuniary externalities. That is the fact that agents do not take into account the impact of their actions on the global economy and in particular on asset prices. So in our setup, we have also the same kind of dynamics, though we do not necessarily focus on this aspect. Then there is a set of papers related to the issue of capital requirements. So Martin Elvik has already talked about his book, but maybe we'll talk more later on today. So the difference, and the MAG was the figure I presented earlier on today. So the difference with our approach is that generally there is no dynamic or really poor macro foundation model. Then there is also the impact or the effect on capital requirements in papers by Martinez, Mira, and Suarez, for example, on the bank's temptation to lend to systemic borrowers. So here we have the same kind of mechanism, especially where banks have low capital requirements, so they take on risk, and they may provide inefficient lending to the corporate sector. And then there is a parallel effort carried out in various papers, which I already referred to in my introduction and also at the IMF. So let's go into the model. So the household sector, as I said, is composed of two dynasties, in fact. So we talk about dynasties here because they provide risk sharing among households. And the main difference is related to the discount factor of these patient and inpatient households. And the dynasties maximize the following utility functions, which depend on positively on consumption, housing goods, and negatively on labor. So the difference in the model is located in the dynamic budget constraints. So for patient households, so they consume, they have their houses and their deposits. Housing is subject to capital depreciation, and what is important is that in this setup, so they have some return from deposit, but their return is depend actually upon the risk of default in the banking sector. So that's what I explained earlier on today. So so they face some costs, which are transaction costs, despite the existence of deposit insurance. So this assumption is important, first because it provides or it introduces a link between the cost of funding for banks and the probability of default. So when the probability of default increases, the cost of funding for banks increases also. It also introduces a wedge between the risk-free rate and the deposit rate. And last, since it depends, I already talked about that, since it depends on average rate of bank failure, but not on the specific risk of failure of the banks in which you have your deposit, this gives rise to this funding cost channel by which riskier banks have an incentive to take on more risk, because they are not charged with a premium which is commensurate to their risk of default. Regarding borrowers, so you have basically the same budget constraint, but they do not hold deposits, and rather they have to borrow in order to finance their housing. So here there is so the dynasty maximizes across the whole the whole members, and it provides risk sharing. So you have limited liability on housing exposure, and for household, so they will get some return from their housing. They will get some services or return from their housing, and they will have to pay their mortgage. The problem of this household is that their housing can be subject to a shock, which is a quality shock, which may affect the value of their housing, and therefore they might this shock may trigger default, and default will occur when the value of their houses falls below their debt repayment obligations. So this is what is expressed there, and from that you can derive a threshold below which default will occur. And what is interesting is that this default depend on this threshold depend on two things. The first thing is housing leverage. So the higher the leverage, the higher the risk of default. And it also depends on the gross return on housing, which is an aggregate variable. And therefore, aggregate shocks, which may impact on this rate of return, will have also an impact on the default risk and the default probability of household. And the same will be if there is a shock to housing prices. Household leverage will increase, and this will raise the probability of default. Banks which supply credit to this household is subject to the following participation constraints. So here again there is limited liability, so that's the reason of the presence of this max and zero. And bank will provide credit to household only to the extent to which the return on lending is greater than what it could get if it if it put this amount to the market. So this is a targeted return, which bank take as an exogenous variable, but which is endogenously determined, and this is the part of the capital which is allocated to the housing sector. So phi is the requirement, the risk weight on the housing on housing loans. So here again, banks may be subject to a specific shock. So here the shock is a shock on the quality of the portfolio. So it may be due to mismanagement of loans, and banks also may default when the value of the return on lending falls below what it has to pay on deposits. So here, when you will increase capital requirements, so the impact would be that you force banks to make larger use of equity funding, but also you reduce bank leverage and default risk, and hence the implicit subsidy. So here, the outcome is that it makes overall housing borrowing more expensive. So entrepreneur, what they do, so they live 2 periods, and in the second period they allocate the wealth they have accumulated in the first period in order to maximize the following utility functions, which depends on 2 things. The first is their consumption, or rather the dividends they will provide to the savers, and the bequest they will give to the next generation of entrepreneurs. So when you maximize this, you find this dividend rule and this retained earning rules. And in the first period, they maximize their wealth, which depend on the return of capital, less the cost of borrowing from banks. And here again, entrepreneurs are subject to a specific shock, and this shock will affect the return of capital. And so when the shock is large, it may be the case that the returns of capital falls below their debt repayment obligation, and in that case they will choose to default. So once again, with the same representation, so banks who lend to these entrepreneurs try to achieve a specific target return, and they also face a shock in the management of their loans. So once again, for entrepreneur, when you can express the threshold below which an entrepreneur will default as a function of first the leverage of entrepreneur and the expected return on capital. So once again, default will depend on leverage and on an aggregate variable. So that is that aggregate shock may also impact the rate of default on entrepreneur. Then bankers are modeled in a similar way as entrepreneurs, so they live two periods, and here again, they maximize this utility function, and part of it is constituted of dividends, which are provided to the savers, and the rest, which is here capital, which is given to the next generation of bankers as return earnings. And then bankers allocate capital in the banking sector, so they have the choice of either allocating their funds to the mortgage lending banks or to the corporate lending banks, and this is their profit maximization. And the condition we find is that you must have an equality of return across sectors, and this also determines the rate of return the external or the rate of return on capital. And so banks finally are modeled as one period project investment in a way. So banks maximizes their profit, and they are subject to a risk, which is a management risk in their portfolio, and they are subject to binding capital constraints. So from that maximization, you can also determine a threshold upon which banks will default, and here default depends also on two things. First, their leverage, and then on the spread between the rate of return on housing or capital and the rate of return on deposits. And then there are additional sectors, but I do not insist on that. They are quite standard, so I move directly to some simulation. So first, regarding the parameterization, so here we calibrate the model on euro area data. As far as capital requirements are concerned, we take the Basel III capital requirements, so 8% and 4% on housing loan lending. We calibrate the model so have to reach the following default rates, so 2% for bankers, 3% for entrepreneurs, and 0.4% for households. And we also calibrate the model so have to reach the average leverage for household and entrepreneur in the range of 70 and 75%. And then the set of the rest of the parameters are quite standard. So the first outcome of the paper is this arm-shaped curve I already presented. So that is this idea that there is an optimal level of capital. So the rationale is the following. So when you have higher capital requirements, so you reduce bank leverage and therefore the risk of bank failure. You also reduce the intensity of bank funding cost channel. That is that as you reduce the probability of bank failure, the funding cost for banks is also reduced. Higher capital requirements also reduce the implicit subsidy which is provided by the deposit insurance agency. But on the other hand, higher capital requirements, they will increase the average cost of funding, and they will tighten credit supply, and therefore the cost of finance for the economy. So there are some caveats, but I do not insist on that. So now looking at the dynamics of the model, so what we do is that we hit the economy with one large shock. So in the following chart, I will show you a shock which is a persistent shock to capital depreciation. So it affects both housing sector and business sector. And what we will look at is the response of the economy depending on whether the financial sector is, so to speak, solid or whether it's not. And what I mean by solid is that we introduce a bank risk shock, that is a shock which represents an uncertainty with respect to the soundness of the banking sector. So when banks are when the probability of financial distress is low, that is the uncertainty regarding the banking sector is low. When you have this negative shock on the economy, the response of the economy is different when banks are poorly capitalized or when they are capitalized at a level which is near to this optimal level. And what you can see is actually that when banks are well capitalized, the response of the economy mimic the response of an economy where bank default is not possible. So what does it mean? It means in fact that when you set up capital requirement at a relatively high level, it isolates in fact the real economy from the shocks or yes, from the financial shocks that will impact the banking sector. Now the response is different when you are in a situation where you have high financial distress. That is when households will start to charge a higher cost of funding for banks. And in this setup, you will see that having high capital requirement mitigate the impact of the shock, but it does not exactly mimic the situation where you have no banks default. But then when banks are poorly capitalized, on the contrary, not only the impact is more pronounced, but also the persistence of the shock is larger. So you have in this setup rooms for amplification stemming from this funding cost channel. And the last result is related to the counter-cyclical adjustment of capital ratios. So here the counter-cyclical adjustment of capital ratios will depend upon the credit to GDP gap ratio as it is in Basel III. So in a situation where you have banks which are already well capitalized, when you release the capital buffer, so you mitigate the negative impact of the shock with respect to a situation where you do not use the counter-cyclical adjustment. But this positive impact of counter-cyclical adjustment does only work when you start from a situation where banks are already well capitalized. On the contrary, when banks are poorly capitalized, when you release the capital buffer, then on the contrary, you trigger the recession in the sense that you make your banking system more fragile. So you generate bank failures, and therefore you have this contagion which occur through lending to the rest of the economy. So to sum up, so we have here a model in which banks and default take center stage. We analyze the impact of steady state of capital requirement at the steady state, and what we find is that having high capital requirement virtually eliminate bank default and the limited liabilities subsidy, and it reduces debt weight cost related to default and bank funding channel. But once you have a level of capital in which the probability of default of banks is pretty low or even zero, then you start to kick on the economy and to impact on credit excessively. Another finding is that shock propagation will depend on the situation of the banking sector, and in particular, shock propagation and amplification are large where bank failure risk is high or when capital requirements are low. And then counter-cyclical adjustment is only beneficial when capital requirements or capital ratio are already high enough. So as a conclusion, so we have a model which is targeted here to sort of inform about the cost and benefits analysis of macroprudential policies. We have also introduced several dimensions of financial instability in this setup, and we think that it is a good starting point to think about and analyze macroprudential policies. But it's the first step in this field of research. So what we are currently working on is to first add additional macroprudential tools like loan-to-value ratios or debt-to-income ratios. So the way we introduce them is as non-binding constraints or occasionally binding constraints, so as to introduce non-linearities. What we are also currently doing is to introduce nominal rigidities to look at the interplay between macroprudential policy and monetary policy. And that's it. Thanks a lot.
Questions, comments? I have problems with your exercise.
If I think of it as an exercise in theoretical modeling and calibration, fine. If I think of it as a tool for policymakers, I'm wondering about the parts that have been left out. You're assuming that banks do not have access to equity markets. Now, in the case of France, the three biggest banks have more than 50% of total bank assets, and they certainly do have access to equity markets. Presumably, access to equity markets has an impact on what it means to impose capital requirements. So the problem I have is that in that respect, the model is counterfactual for what is, after all, more than 50% of the French banking system. And as we've discussed in the overbanking paper of the Advisory Scientific Committee of the ESRB, this isn't just the case for France, but for many countries. Another feature, you're assuming specialized banks, and you're assuming that the only activity of banks is lending. If you look at the actual expansion, and that funding comes from deposits. If you look at the expansion of banking systems over the past 25 years, much of it involves funding through wholesale markets, and much of it involves trading and derivatives. So the question I have is, what precisely do you mean when you say that this is a useful tool to policymakers? And in what sense do you think that the numbers you provide with on the basis of a model that excludes essential parts of what we've seen happening, that those numbers are relevant for actual policy choices?
So as far as the first question is concerned, so here, as I said, this is the first step. So the paper at this stage is mostly theoretical, and actually effectively is providing a very limited picture or vision of the banking sector. And as you rightly point out, there is no equity market, which is something that is missing, and effectively regarding the asset side of the bank, it is only limited to loans here. So I think that this model, but also the other one, which are currently developed in the macro environment, are not yet able to have a proper vision of what is a bank. And the way we model it, I mean, shows that it is not satisfactory at this stage. Regarding the figures, so I would say I would have the same response. So far, I mean, we just have a model which is a kind of very simplistic model, and the calibration is crude. So I would not take for granted the result regarding the numbers, especially this optimal capital, whether it's 10 or 15, it depends really on the calibration. So, but the fact is that what we see in the model is that, and with respect especially to the kind of proposal you have made, there are some level at which too high capital requirement will have an impact. And so this is, I think, the one of the policy aspect which is important, which is that at some point when you have basically isolated the banking sector for the risk of default, whether it's possible, I mean, or not, but at some point you only have the negative impact related to additional capital requirements. But on the figure, I mean, 10.5 or 12%, I don't know.
I have a similar problem that to the one that was raised by Martin Henry. I mean, in my understanding, models can serve two purposes. So either you have a model to understand a mechanism abstractly, and then the mathematical modeling can help you to establish the conceptual and the logical truth of this model, whether the parts fit together. Or you can have models that try to quantify things in the real world, where you put numbers on it, but then you need evidence and trust that the model you are calibrating or putting the numbers on is describing actually what's going on in the world. And your answer to Martin Helwig's question seemed to be, this is too crude. If we approximate it further and put more elements in it, we will get a better approximation. But this is not the point, I think. I mean, if you do not have some evidence or trust that you're capturing how the economy works, putting these numbers on the equations does not mean very much.
No, I agree. The point is that, well, I think here the thing is that what we are trying to focus on are key transmission mechanism, and in particular the one which are related to the risk of default or default of the different categories. So I think that is the real purpose of the model. So how does it play? What is the interplay between the different network channels? So that's I think the target and the main contribution of the paper. Now I agree that at this stage the model is not developed enough to go to the quantified version. But at least I think that the model have a say, or eventually yes, a fairly good representation of how default risk might impact on the economy and what are the underlying channels. So from that perspective, I think that's our focus.
So you described how household leverage influences the default probability of the households, and I wonder, could you expand or elaborate on loan to value and debt to income, whether these differently affect the household default rates in your model?
So so here let's see, the other way around. So here, when you will introduce loan to values, basically what you will constrain is this figure. So therefore, you will have an impact on the risk of default, etc. Now, what we have started to do is to introduce LTV in the context of that model, and what we find is actually not really what we find is actually that leverage is endogenous. So when you introduce a constraint, there is an endogenous response by the banking sector, which then limit the amount of loans and limit leverage of the economy. And therefore, the imposing a loan-to-value constraint does not bind, as there is an endogenous response of the model. So the reason is that in this model, there is the link between the value of the housing and the amount of loan is not as strong as you can have in other models of financial amplification like Bernanke-Gelt or Gilchrist. So I think that one outcome we can already have from this modelization is that depending on the way household can borrow and the extent to which you can have this possibility of mortgage equity withdrawal, have a different impact on the macroprudential instrument. So typically there will be economies in which imposing a loan-to-value ratio will not bind, whereas there are others where it will limit the amount of credit and indebtedness in the household sector.
It's on this slide here.
you're making a very strong assumption on the default trigger by the household sector.
Yes.
You assume that the people default on their mortgage
Mhm.
if the value of the house falls below the net present value of
Mhm.
the payments, right? It's true for the US as well, experienced in 2007, but in Europe, in France, for example,
Yeah.
if you default on your mortgage, the bank goes after your house, but also after all your other assets, right?
Yes.
I'm wondering,
So here,
how does it affect?
no, here effectively you're right. So these are non-recourse loans. So this is more the situation in which corresponds to the US. The only consideration we have here is that in fact you have a dynasty which take care of all its members and which provides some form of risk sharing, meaning that when you default, in fact your friends, family, etc. will contribute to that and then therefore help in a way the household, so that in effect is he has limited liability on his housing portfolio. But I agree that the mechanism which we describe is not necessarily the one that you have in France, for instance, where effectively you will have to sell your car and etc.
I have another question. Yeah, it seems that you assume that the average cost of funding increases if the level of capital increases.
Mhm.
But at the same time, if the bank is less risky, the required rate of return on capital is lower. So I'm wondering if
So yes, you have different.
into account in
Yes, you have different effects. So when capital requirements increases, what you have also is that the probability of default of the banking sector is decreasing, and therefore the premium which is requested by depositors is falling. So you have this counterbalancing effect. So on the one hand, you have, because capital is scarce, it's more costly for banks because it has to allocate differently its liabilities, so have more capital, but at a cost. So this cost will be factored in the loans or provided to the real sector. But on the other hand, the cost of funding will decrease. So you have two offsetting forces. And what you see is that these forces do play differently depending where you are in terms of capital already.
I'll take one more question. So have to come out of the coffee break.
One key feature you insisted on, and also in Tobias's talk, he insisted on that this asymmetric shape of the hump-shaped curve. I understand very easily why there is a hump, but this asymmetry, I would like to understand what the mechanism behind it is. Is it a result of the calibration, the specific form of the assumptions in the model, or is it generic in the model? If you change parameters, this asymmetry is concept? Because in Tobias's model, it was somewhat different. He had a single agent with risk aversion, log utility. Here, it seems you have risk neutral agents.
Yes. No, I think that the reason of this asymmetry is that in the low capital ratios environment, what you have is you have date rate losses, which really impact on the economy. So here everybody can default, and so that is really more costly than what you have on the upper side, where here it's just an increase in the cost of funding. Eventually, what we miss in the higher part is the possibility of credit crunch, because when capital, when you require additional capital requirements in the short term, I mean, a way for a bank to accommodate for that is really to cut on credit massively, so that we don't have this credit crunch externality. So here you just have an impact on the cost of funding, which is probably which has less impact than the cost of default when everybody runs into trouble. So I think that's the explanation of this form.
But in your model, is that asymmetry generic, or is it only obtained for certain?
No, I think it's due to the fact that you have these defaults. So, for instance, in a model where you don't have this default, like the one of Beguenot, in a setup which is otherwise quite similar, you have a rather asymmetric response. So here it's really due to the fact that here date weight losses are very, very large because there are a lot of defaults when capital requirements are too low.
Thank you very much.